Hello, ladies and gentlemen. Welcome to my trading room where I show you how to trade divergence properly. My name is Nana Osai, and in this video, I want to point out a very important error that I have identified in trading videos that seek to teach how to trade divergence. So, without wasting your time, let's get right into it. So we know that in trading divergence, we look at oscillator and the candlestick charts. Now, we say that there is a bullish divergence where price makes a lower low and the oscillator makes a higher low. However, you may have observed that normally when the gurus are looking at connecting the lows with the bars, what they do is to bring it to the very lows, the lowest lows. That is the error that is affecting successful trading because if you look at the oscillator, okay, the oscillator applies to the closes and not the lows. If you place your cursor on a candlestick, what it shows you are the low point, the close. The RS, the RSI applies to the close and not the low. Okay, and therefore it's necessary to apply your lines to the closest instead of the lows. So that's the error. So that's the error that the guru traders have been committing in trading, in teaching us how to trade. And this, I hope, has added something significant to your trading. So in a place like this, if you are connecting, you are looking at the highs of the bullish candle. If you are looking for bearish divergence, you connect the highs. You connect the highs of the you connect the highs of the bullish candles. Okay. Yeah, and then you compare that to the oscillators levels. All right. Okay. There's another example. So there is divergence, clearly divergence. But let's see how um this way of trading divergence properly plays a significant role. Now here, we realize that the RSI made a lower high. In comparing that with this, you might think that um, okay, so if you connect the bar to the closest of the highs, then you get something like this. So then it becomes very obvious over here for you. All right. So um, thank you so much for watching this video, and I hope you have learned something significant. In trading divergence, you don't look at the highs or the lows. You look at the closest. Okay, and in checking at the oscillator level too, you look at the level. Sometimes the oscillator movement is such that it is difficult to tell whether the price is the level is one of the levels is higher than the other or the other way around. So what you can do with that as well is just to point the cursor to put the cursor on the lower point, the lowest point that you are looking at, you will find a figure. The value is 39.18. Okay, so if you are comparing with here, you have what? You have 38.74, meaning that this level is lower than this level. At the same time, when you are checking the price levels of the candlesticks, you can just place your cursor on the candlestick and it gives you the low, the close, the high, the open. It gives you all those figures, and based on that, you're able to tell which of those levels is higher than the other, and so on. So thank you so much, and that is the points I would add to my video on how to trade divergence properly. But to conclude, I would like to quickly tell you about my my trading manual, um, that I have titled "Read Market Structure Properly." Read market structure properly. This manual delves into the the science, if you like, or the technicals of um, market structure trading. Um, so let me quickly explain what exactly this manual um, tries to achieve. Um, in reading market structure, we look at pivot points. We look at pivot points. We call this high, low, sorry, high, higher low, high, lower low, lower high, lower low, lower high, lower low. If you get here, you get some traders would say there's a higher high, higher low, higher high, lower low, and so on. However, in reading market structure, it's important to use a model or something that guides your objective reading of the candlesticks. For example, if I were reading this market structure, I would have, of course, counted these lows, and so on. But over here, I would not have counted this as a higher high and a higher low and a higher high. I wouldn't have done that, because there are factors I would consider in validating the pivot points that I can consider as highs or lows. For example, in this context, all these would have been considered as valid pivot points, so I could have said, okay, this lower low, lower high, lower low, lower high, lower low. But here, this part wouldn't have qualified as a higher high, nor higher low. It would have come somewhere here. It would have come somewhere here for me to consider this um, as a higher high. In my approach here, from here to here, for some reason, I would have considered here as a higher low and a double top and a lower low. So I would have considered this as a breaking structure, and then the market break structure upwards and so on. Um, So what the manual seeks to explain is to give you a model based on which you can validate your pivot points and be able to trade market structure successfully. Um, the manual also explains how to trade both the macro trend and the micro trend. And in the manual, we explore all these concepts. Um, So I would encourage you to look at the redacted version of the manual. Actually, the manual is available in a redacted version. The purpose is to invite actually interested traders to book for 60-minute live trading sessions where we would explore the contents of the manual. The manual has very important um, lessons, and you would realize that by subscribing to that 60 minutes session of learning how to trade market structure properly, you would do yourself a lot of good. Once again, my name is Nanosai, and I wish you well.